Hello, this is Christine Linke, Webcast Manager at Premia, and I'm pleased to welcome you to this Premia webinar. Today, Professor Stijn van Nieuwerburgh will present the webinar, Making Europe Safer. He is the Associate Professor of Finance at New York University's Stern School of Business, where his primary research areas include finance and macroeconomics. Please feel free to submit your questions to the presenter via the question pane on the right-hand side of your screen at any time during the presentation. Questions will be answered at the end of the session as time allows. Following this webinar, a link to the presentation will be emailed to you, along with a link to the recording of today's webinar. And so with that, I will turn it over to you, Stijn.
Thank you. Thank you for joining me. So today I'd like to talk to you about a proposal on how to make Europe safer. And I've developed this proposal with a team of European economists, all of which are nonpartisan, and we've been brainstorming and collaborating for the last 9 months or so on new ideas to stem the European crisis. So we call ourselves Euronomics, the Euronomics group, and you can follow us on our website, www.euronomics.com. Before I start, let me mention that this webinar is sponsored by the NYU Stern Masters of Science program in Risk Management. This program is geared towards executives who want to study various angles of risk management in depth. And the modules are held in New York City, Hong Kong, and in Europe. I've been teaching a module on structured finance in this program since its inception, and I have to say that personally, I've been very impressed with the high quality of the students. So if you're interested, please refer to the contact information below. So here's a plan for my talk today. I'm going to start with a short diagnosis of how we got to the present-day difficulties that confront the Eurozone. I'm going to highlight what I think are two important facts. The first one is destabilizing capital flows between the European core countries like Germany and the European periphery countries like Spain and Greece. The second is what I call a diabolical loop between the sovereign debt crises and the banking crises, which kind of mutually feed on each other. The main part of my talk is going to be devoted towards introducing a proposal to make Europe safer that addresses both this diabolical loop and these destabilizing capital flow problems. And then, time permitting, at the end, I will briefly mention some other parts of our proposal on financial sector reform. So let me start by putting two facts on the table. The first fact is that long-term interest rates on government bonds from periphery countries like Spain have been nearly identical to those of core countries like Germany. And this has been going on since the adoption of the euro in 2002. It followed a period of convergence dynamics after the signing of the Maastricht Treaty in early 1990s, where the periphery bond yields, like the Spanish bond yield, came down very sharply. And it's only relatively recently, after the financial crisis in the United States, and then especially in the last couple of years, that this convergence dynamic has been reversed, with Spanish interest rates now more than 4 percentage points higher than the German sovereign bond interest rates. We see a very similar picture for Italy, which is the red line on the graph, and even more extreme dynamics for Greece, which is the purple line. So with Greece's sovereign bond yields today at 30% per year, a 28% spread over German bond yields, which kind of completely undoes all the convergence dynamics that had taken place in the preceding 15 years. The second important fact I want to put on the table is that there's been a divergence in price levels between core and periphery countries. So what this picture plots is the harmonized consumer price index normalized to 100 in 1999, and it shows that German inflation has been much more subdued than price level changes in Spain. They've seen the Spanish have seen much faster rising prices and wages. And this picture looks even more extreme for Greece, again in purple, and even in France and in Italy there was higher inflation than there was in Germany. So basically Germany was able to keep price growth in check due to a decade of wage moderation, while in other countries like Greece and Spain, prices and wages increased much faster, eroding the competitiveness of these countries. So when we combine these two facts, the interest rates, the nominal interest rates that were basically the same due to these convergence dynamics between core and periphery, and the fact that inflation rates were so different, we can back out what implicit real interest rates were as the difference between nominal interest rates in the first row of the table and inflation rates in the second row of the table. And what you see in the last row of the table is that real interest rates in Germany were substantially higher than in Spain and in Greece. Now what that means is that the real cost of borrowing for Spanish and Greek borrowers, both private and public, was much lower than the cost of borrowing for the Germans, and conversely that the rate of return on saving was much higher in Germany than it was in the periphery countries. This wedge between real interest rates in core and periphery led to capital outflows out of surplus countries like Germany and into deficit countries like Spain, Greece, and also Ireland. And in these periphery countries, these deficit countries, it financed both private and public sector borrowing. Then this private and sector public borrowing further fueled wage and price increases, which further increased this real interest rate gap and further amplified these capital flow patterns. Now these capital flow patterns, these capital flows were really big. What this picture shows is that Germany saw cumulative net capital outflows of about 1.2 trillion euros over the last, say, 7 to 10 years, while Spain was the recipient of huge capital inflows to the tune of 700 billion euros over that same period. Greece also received very large capital inflows, especially given the size of its much smaller economy. So total German capital outflows were basically as big as all the inflows in Spain, Italy, and Greece combined. So you could say that Germany basically financed the deficits of Spain, Greece, and Italy combined. Now these capital inflows then fueled a boom in the periphery. Spain and Ireland used that money to finance residential investment, while in Greece, for example, it financed an expansion of credit to the household sector, which boosted consumption. As a result, kind of GDP growth looked really high in countries like Spain, Ireland, and Greece for a long time, whereas GDP growth in Germany looked subdued due to the wage moderation and the sluggish consumption that wage moderation implied. Now, these trends were reversed in the last few years when Germany started to grow much more quickly, while the Spanish economy stalled in the wake of its real estate collapse. Okay, the pattern is the same basically for Greece and Ireland, which saw strong GDP growth for a decade financed with these capital inflows. So far I've basically described capital flowing from the periphery to the core in good times. Now during the crisis of the last couple of years, this pattern of capital flows was sharply reversed, with capital flowing from the periphery towards the core. Okay, so we've seen these large, very destabilizing capital flows between core and periphery countries in good times from core to periphery, in bad times for a flight to safety from periphery to core. And kind of in the crisis, what that did is it basically made the German bonds basically the safe haven investment to flock to, where bond prices were rising and bond interest rates were falling, whereas investors were fleeing from Italian, Spanish, and Greek bonds, pushing their prices down and their sovereign interest rates up. Okay, much to the detriment, as we all know, of these countries. So that's kind of my first diagnosis of the crisis, which is basically destabilizing capital flows between core and periphery. The second important source of instability in the system is this close connection between the fragility in the European banking system and the fragility of the European sovereigns. This connection stems from the fact that European banks, at least until very recently, held a disproportionate share of their assets on their balance sheet in the form of bonds of their own sovereign. Now you may wonder, why did Italian banks load up on Italian sovereign bonds? Well, because they had good reasons to do so. First, bank capital regulation under the Basel directives gave a zero risk weight to bonds of the own sovereign. So banks could essentially hold Italian banks could hold Italian sovereign bonds without holding any capital against that. Second, banks could borrow funds from the ECB, from the European Central Bank, using these same sovereign Italian bonds as collateral, and this collateral was treated by the ECB as essentially risk-free, leading to very small haircuts. Okay, and so these regulatory and ECB policies remained in place even in the last few years, as it became plain obvious to everybody that Italian and Greek bonds were not the perfect risk-free assets for banks to hold on to, nor the perfect collateral for the ECB to lend against. But because the yields on these Italian bonds were now higher, banks had an even stronger incentive to hold these Italian bonds than they did before. Okay, so it's kind of important to note that, like, as these Italian and these Greek and these Spanish sovereign bonds became less or more risky, that kind of endangered the health of these these Italian, Spanish, and Greek banks that were holding on to these bonds. So this situation of banks holding their own sovereign bonds feeds a never-ending speculation on the solvency of the banks themselves. Okay, so sovereigns, in turn, face this constant risk of then having to rescue their banks, but the possibility of having to bail out their banking system makes investors doubt the solvency of the sovereign. So those doubts further erode the value of the bank's sovereign bond holdings. And so we have this loop. And in response to this deteriorated value of their sovereign assets, banks may cut lending to other borrowers, which would create kind of a credit crunch, reducing the growth in the real economy. Reduced growth in the real economy would lower tax revenues. That would further increase the problems of the sovereign, and so forth. Okay, so we end up with what we call a diabolical loop of a banking and a sovereign debt crisis that mutually reinforce each other. Now, to the extent that there's no credible European-level rescue funds to aid all of these troubled sovereigns and banks, you can kind of see how this problem can spiral out of control. And ultimately, the ECB becomes the sole source of financing both for troubled banks and for troubled sovereigns, because private market creditors lose confidence in the system. And I fear that we're already quite a ways down this path today. So that concludes the first part of my talk, which is on kind of a diagnosis of kind of some of the key instabilities in the system, where I talked about destabilizing capital flows, and I talked about the diabolic loop between the banking and the sovereign crisis, which is called the twin crisis. So let me turn to the first polling question for you, which is, in your mind, what was the biggest cause of the divergence in performance between periphery countries like Spain and Greece and Italy and core countries like Germany and France in the last decade? Is it A, a lack of fiscal discipline of governments in the periphery? B, cheap money encouraged too much private sector borrowing in the periphery? C, productivity differences between core and periphery? And D, financial system fragility in the periphery? Okay, so let me turn it over to the moderator now.
Okay, everyone, I'm going to launch this question, so you have a few moments to mark your answers, and we'll come back on and announce the results momentarily. Okay, we have about 75% of the audience that has voted, so I'm going to close the poll and announce the results. And Professor, on this question, we had 38% of the audience selected A, 29% selected B, 23% selected C, and 11% selected D.
Thank you very much. Okay, so now let me turn to the main part of my presentation today, which is our proposal to create what we call European Safe Bonds, or ESPYs for short. So these bonds would be European in the sense that they would be issued by a new European debt agency, which I'll talk about in the next slide. They would be safe because they would be designed to minimize the risk of default, and they would be bonds freely traded in markets and held by banks to satisfy the bank's demand for safe assets that I just highlighted. So banks would then have an alternative to sovereign bonds that would allow that would be safe, and that would allow them to become better diversified and less dependent on their own country's public finances. In fact, I think these European safe bonds would be extremely useful for many investors who currently lack a large, liquid, safe European asset market. Think, for example, of the Chinese or the Japanese central bank, or think of pension funds who would love to be able to better diversify their current dollar exposure. If you think of the U.S. Treasury as maybe one of the few truly safe assets in the world right now. Okay, so the ESPYs could play that equivalent role to the world economy. Now the success of the ESPYs proposal, which I'll elaborate on in a second, would depend on two regulatory changes that would need to be implemented, now, both of which I think are relatively minor. First, the ECB would have to grant strict preferential treatment to the ESPYs and accept them as its main form of collateral in repo and discounting operations. So basically, in effect, the ECB would still be holding sovereign bonds as assets, but it would now be holding them indirectly via these ESPYs. And it would only hold the safest component of these sovereign bonds. So it would also conduct its monetary policy operations via these ESPYs without having to automatically take on credit risk, as it does now when it buys sovereign bonds for monetary policy purposes. The second regulatory change that would need to take place is that banking regulators, including the Basel directives, would have to give a zero risk weight only to the ESPYs, okay, because they would be the only safe asset. Whereas sovereign bonds that currently receive a zero risk weight, the Italian banks holding Italian bonds, example I gave before, those Italian sovereign bonds would now receive a positive risk weight that would truly reflect the riskiness of these bonds. And just like corporate bonds or corporate loans receive a capital risk weight that is commensurate to their risk. Okay. So what does our proposal amount to? So practically speaking, we envision that there would be a new European debt agency, call it the EDA, that would buy the sovereign bonds of all 17 Eurozone member nations and passively hold that sovereign bond portfolio on its asset side. Okay, this is what's drawn on the asset side of that balance sheet. The portfolio weight of each of the 17 sovereign bonds in that portfolio would be set equal to the relative size of that country's economy as a share of the Eurozone economy total. Okay, and so to avoid large changes in portfolio weights over time, we favor setting the weights equal to the weighted average GDP share of that country averaged over the past 5 years. On the assets, so the asset side, the other point that is important about the asset side is that the EDA would not be buying all the bonds, all the debt of the sovereigns. It would only buy maximum 60% of Eurozone GDP. Okay, so the 60% to GDP number is kind of a magical number that also features prominently in the Maastricht Treaty. So the maximum asset size, given today's size of the European economy, would be 5.5 trillion euros. That's 60% of Eurozone GDP. So against that 5.5 trillion euro portfolio, the EDA would issue two securities, which would show up on its liability side. We call them European Safe Bonds, or ESPYs, and European Junior Bonds, or EJBs. So the first security, the ESPYs, would represent a senior claim to the payments from the sovereign bond portfolio, whereas the second security, European Junior Bonds, are a junior claim to the payments of the portfolio. Both of these claims, both of these securities, would be sold to the private market, so that in the basic form, our proposal does not involve any government guarantee or any government bailout whatsoever. Okay, they're basically just two new securities that are sold to the private market. Now the cutoff between the relative size of the ESPYs and the European Junior Bonds, let's call that X. Okay, so the X percent means that the first X percent of portfolio losses because of European sovereign defaults would have no effect on the payment of the ESPYs. They would only hit the European Junior Bonds. That number X has to be chosen large enough so that even in a worst case scenario, think of a partial default by Greece, Portugal, Ireland, Italy, and Spain, the payment on the ESPYs would still not be jeopardized. Now in contrast with the ESPYs, the EJBs are a risky security because they essentially would absorb all the losses that would accrue due to possible sovereign defaults. So despite the fact that they're a junior claim, I should also emphasize that the EJB bondholders would not have any, they are not equity holders in the sense that they would not have any control rights to the EDA. They would simply be plain vanilla junior bondholders, and because these EJBs are essentially concentrated bets on sovereign default in Europe, they would be very risky securities, and they would have a commensurate high expected return. So in addition to providing this safe assets that European banks currently lack and that other world investors currently need, what this proposal does is it helps to also solve the problem of destabilizing cross-border capital flows that I emphasized before. Okay, so I emphasized before these asymmetric shifts of capital across borders from periphery to core in bad times and from core to periphery in good times. After the ESPYs would be introduced, this flight to capital to a safe haven would no longer be a cross-borders capital flight, but it would be basically a shift between European bonds. It would be a shift between ESPYs and European junior bonds. So in good times, the default risk would fall, and so the value of the EJBs, the junior bonds, would appreciate, reduce, and the value of the ESPYs would fall. Whereas in bad times, the flight to safety would have people clamor for ESPYs that would push up the price of ESPYs. Its value would increase at the expense of the European junior bonds. So basically, the capital shifts are now between ESPYs and European junior bonds, and that stabilizes the asset side. Now, what's the asset side? The asset side are the sovereign bonds of the Euro nations. So we'll now have more stable interest rates on Italian and Spanish bonds than we have kind of absent this scheme. So this would stabilize, if you like, the entire financial ecosystem, because it would also stabilize the banks who would be holding these securities. Now, the other important point to note about our proposal is that ESPYs would not distort incentives for sovereigns to undertake structural reform. Why is that? Well, remember that the maximum amount of debt that can be bought by the EDA would be capped at 60% of GDP. Now, nearly all Eurozone countries today have debt-to-GDP ratios well above 60%. Italy, for example, has a debt-to-GDP ratio of 120%. So that means that these countries would still have to finance more and place more than half, or like Italy would have to place half of its bonds in the open market. Okay, so sovereign bonds would still continue to exist in their current form. It's just that there would be a large purchaser for these, for a share of them. Like in Italy's case, half of them would be bought by the EDA, whereas the other half would still need to be bought by market participants. And so the interest rate can still be basically an appropriate signal or a market force for the disciplining the government of Italy and of other periphery countries to do the right structural reforms that are needed to kind of encourage long-run economic growth. In fact, you could argue that once the ESPYs are introduced, the economy could move to a new stable equilibrium that allows governments basically for the first time to credibly commit not to bail out. Okay, and so you could argue that interest rates could become even more informative than they are today as opposed to less informative. So to summarize some of the advantages of the ESPY proposal, we think it would bring stability to the banking sector by breaking that diabolical loop between banking and sovereign crises. It would eliminate capital flow imbalances due to a search for safe haven, replacing those with capital flows between European safe bonds and European junior bonds. The ESPYs would be very desirable securities, so they would basically be very liquid, they would be very safe, and so that would generate a liquidity premium, which we estimate would be worth about 40 billion euros per year. That liquidity premium is now smaller, and it now mostly accrues to Germany. Germany basically enjoys the revenues from that liquidity premium. Whereas in our proposal, these liquidity premium revenues would be shared among all the Eurozone members. The last two advantages I think are very important. Because our scheme does not involve any government guarantees or any bailout, it's a scheme that does not involve any fiscal transfers or any joint liability, completely unlike Eurobonds. So you may have heard of these Eurobonds. The idea of Eurobonds is to also buy all the debt of sovereign bonds and issue one security against that, called a Eurobond, which would have basically all the credit risk of all the countries, and these Eurobonds basically would be guaranteed by the joint and several guarantee liability of all the taxpayers in Europe. So they basically amount to a fiscal union, a political union, where where German taxpayers are on the hook for the Greek debts. There's no such thing in our proposal. We just have markets buying securities, and we came up with a way of repackaging the risk that is in the current existing sovereign bonds so as to create one very risky asset and one very safe asset. The other big advantage of our proposal is that it would not require any European treaty changes to implement, again, in contrast to, for example, Eurobonds, which would mean that it could be implemented fairly soon and it could contribute fairly quickly to the short-run crisis situation in Europe. I will return to the short run in a little bit. So let me now address a few design issues. So one important question is how to come up with a percentage of European junior bonds versus European safe bonds. So here the design principle is to maximize safety, not profits. Okay, so you may recall that in the subprime mortgage crisis in the United States, a lot of mortgages were pulled into so-called mortgage-backed securities and then were tranched, where there was a large fraction of the pool of collateral that was given a AAA tranche by the rating agencies. Now, in that situation, the fraction that was safe, that was AAA, was really designed to maximize profits, not to maximize safety, and we now know ex post that way too high a fraction of these mortgage-backed securities were rated AAA. So we don't want to make the same mistake. So what we propose is a very conservative set of assumptions. And under this conservative set of assumptions, we claim that about 30% of the capital structure of the EDA could consist of European junior bonds, whereas the rest, the other 70%, could be European safe bonds. That 30% number, which you can read in much more detail in our proposal, which is available on euronomics.com, is based on a set of very conservative assumptions on sovereign default probabilities, on the correlation of sovereign default probabilities. So we have different macro scenarios, a good scenario, a bad scenario, a catastrophic macroeconomic scenario that induces correlation, and we overlay on those scenarios contingencies along the lines of if Italy goes bankrupt, Spain also goes bankrupt with very high likelihood. You know, if Germany goes bankrupt, all the Eurozone countries go bankrupt with very high likelihood, and so forth. And lastly, we also have a loss given default assumptions that are conservative and that are based on loss given default on corporate bonds of similar credit ratings. Now, based on our simulations, what we find is that ESPYs would sustain losses in only 0.8% of the 5-year simulations. So basically once every 600 years. So we think that would be very safe. In fact, ESPYs would be safer than German bonds, for example. So far I've kind of emphasized that our proposal does not involve any government guarantees. But in one variant of our proposal, which is not necessarily our benchmark, in one variant we provide for an additional layer of protection to the ESPYs. And that additional layer of protection to the ESPYs would come in the form of a partial capital guarantee, or so-called credit enhancement. So in the unlikely event that the losses to the EDA portfolio were to exceed the size of the European junior bonds, let's say 30%, then the government would step in and cover some of the losses on the ESPYs. So then the ESPYs would be hit, and so our idea is that maybe the first few hundred billion of losses onto the ESPY holders could be covered by a credit enhancement. This credit enhancement could be fully funded ahead of time by the governments, by the Eurozone governments. This could be, for example, done by the EFSF, the European Financial Stability Fund, which would basically hold this credit enhancement as on its balance sheet as on the liability side, and then would hold assets against that, for example, gold, to kind of fully fund those. Okay, and one advantage of this extra layer of protection is that it would allow for different vintages of these ESPYs to be more similar over time, and thereby would promote the liquidity of these ESPYs. Now, we think it's important that this credit enhancement is provided by a public entity rather than a private entity, because a private insurer would automatically be considered too big to fail, which would make the private insurance too cheap, underpriced. So second, I think it's important to have a public entity do this, because a private entity would have the temptation to create too many ESPYs and too few European junior bonds, because that would maximize profits. So there's basically a trade-off between the liquidity, the size of the ESPYs, and safety. And we think such a trade-off between liquidity and safety is best internalized by a government. A second set of design issues have to do with the governance of the European Debt Agency. So what we envision is that the EDA would be a very small entity that would really be quite boring, because it would just simply passively hold the sovereign bond portfolio and just regularly issue ESPYs and European junior bonds. Importantly, the portfolio choice of what fraction of each country's sovereign bonds to hold would be completely mechanical. It would be guided by a strict, stable, credible, and transparent rule, like each country participates in proportion to the size of its economy as measured by the weighted average GDP rate from the last 5 years. What that kind of formulaic and unambiguous rule does is that it basically shields the EDA from political interference. Because no doubt in a crisis, let's say Italy or Spain run into trouble, the politicians would want the EDA to step up its purchases of Spanish bonds. But that would make the ESPYs no longer safe. So I think it's really important that we provide for truly safe securities, and that necessitates having this formulaic, very strict rules about what the relative participations of each of the sovereign nations in this scheme. In addition, we could envision that the rules should be included in the ESPY's contract themselves, so that if they were ever changed, or if there were ever a temptation to change, the EDA would expose itself to lawsuits from investors in ESPYs. Okay, and I think having that written as part of the bond covenant would make the EDA or the politicians think twice about kind of changing the rules of the game midway through. So all of these safeguards may seem extreme, but I think they're inevitable given the events of the past year, and they're ultimately necessary for making ESPYs truly safe securities. Okay, so now that you know a little bit more about what ESPYs and European junior bonds are, let me ask you the following portfolio investment question, if you like. So imagine you had 100,000 euros to invest for 10 years, and the question is, how would you allocate it? And the assumptions you should make is that ESPYs earn 2% per year for 10 years. That's their yields to maturity, if you like. And European junior bonds, because they're risky securities, they have a much higher return. Let's imagine they have a 10% rate of return per year. So answer A, I would invest everything in ESPYs. Answer B, I would put half in ESPYs and half in European junior bonds. Answer C, I would invest everything in European junior bonds. And answer D, I would stay away from European bonds altogether. So let me turn it over to the moderator now.
Okay, everyone, I'm going to go ahead and send this question up to the audience, and we'll give you a few moments to mark your answer. Okay, we have about 75% of the audience who's marked their answers, so I'm going to go ahead and close the poll and announce the results. And Stijn, on this question, we had 15% of the audience selected A, 43% selected B, 3% selected C, and 38% selected D.
Thank you. Thank you. Very useful. Okay, so now that I've described kind of the main setup of the ESPYs and European Junior Bond proposal, and I've kind of highlighted the long-run advantages of this scheme, I want to make the point that ESPYs can also help short-run to kind of stem the current panic, if you like, in European debt markets. Why is that? Well, I think first, these ESPYs could get markets into a new equilibrium, into a better equilibrium, by showing a clear path out of the current swamp. So we think of our proposal as a game changer. Some people call it a bazooka, because it introduces a large and a permanent source of demand for 5.5 trillion euros worth of sovereign bonds. Okay, so given the current panic on the European bond market, I think this guaranteed source of demand could eliminate this current spiral of uncertainties where sovereign countries have seen the demand for their bonds dry up and their yields go up a lot. So the EDA would purchase these sovereign bonds at secondary market prices so that there would be no distortion and no hidden subsidy. But they would just make sure that these bond markets don't freeze. Like, for example, bond markets in Ireland or for Greek bonds are completely frozen today. And I think in the process of unfreezing these markets, calm would return to the markets, expectations could be realigned with fundamentals, and yields on all European bonds would come down, but especially in the problem countries. Now, once it's running at its full size, we envision that the EDA would be buying bonds in secondary markets. But given the current crisis, I think we actually could do more. We propose that in the ramp-up phase, as the EDA gets to its full capacity, we propose that it would buy bonds in the primary market. So in the worst case scenario, it could be that the EDA would be the only buyer, let's say, of Spanish debt in the primary market. So we think of that as a short-term compromise that could help overcome the funding crisis of some of the European sovereigns. Okay, so just to give you a concrete example, in the transition phase, the EDA could buy up to 940 billion euros worth of newly issued Italian bonds. That's basically 60% of Italian GDP. That's basically the steady state size that Italy would have in the ESPYs in our scheme, in our EDA scheme. So 940 billion in Italian sovereign bonds, that basically would take care of the Italian government's financing needs for the next 3 years. Okay, so that would clearly bring a lot of relief to bond markets. And so the idea is that countries would now have at least 3 years of breathing room to make the necessary structural adjustments and ride out the current business cycle. Now finally, I should say that in the transition, so when we start this up, we envision that Greece, Ireland, and Portugal would not be part of the ESPY scheme. One reason for that is that they're currently already receiving help through the Troika, and they're receiving help at rates that are much lower, that are much more favorable to them than what they could possibly hope to get from the EDA through the ESPY scheme. Also, there's no market for their debt right now, so it's hard to establish a price at which the EDA could buy their bonds. And so we also, finally, we think that once they leave the program, the Troika program, they could participate, and their participation could be kind of a carrot that would incentivize them to undertake the necessary reforms to get out of the current program. Now, one question that came up kind of in response to our proposal, and in fact, it also came up in your answer to polling question 2, is who would buy these European junior bonds? So a lot of you, actually very few of you indicated that you would buy just junior bonds. In fact, I believe 3% of you said you would just buy the European junior bonds. A large group of you, 44%, said you would buy a mix of European junior and European safe bonds. So I believe that there would be a lot of demand for the European safe bonds by pension funds, by Chinese central banks, and so forth, by households. So I'm not too worried about that. But the question is, in the short run and in the midst of a crisis, where would the demand for a new investment, a new instrument, European junior bonds, come from? Remember, if we start the system, in the steady state, there would be 1.6 trillion euros worth of these European junior bonds out there, which is really a considerable amount of money. So, we think hedge funds and sovereign wealth funds are a natural group of investors to invest in these funds. So you could say, well, can't they take on a levered bet on sovereign risk already? And the answer is yes, they can. They can buy a portfolio of Greek and Italian and Spanish bonds already. In fact, many mutual funds have. Just think of MF Global. And they can lever up that portfolio by funding it through borrowing. But then they would be faced with margin calls, and that may force them to delever at exactly the worst possible time. So one advantage of these European junior bonds is that they provide what's called fixed embedded leverage, so that no borrowing and no margin calls would arise in order to take this concentrated risk bet. Okay, so I think that's an attractive feature. You could also imagine that we could retailize this junior bond. So for example, we could design exchange-traded funds for retail investors with EJBs as the underlying asset. Now, the last point I want to make is that in the U.S., for example, municipal bonds are held mostly by households. In many European countries, like Italy or Belgium, the domestic households are holding most of the sovereign bonds, or a large fraction of the sovereign bonds. And so, it's conceivable that households themselves would be interested in not only in the ESPYs but also in the EJBs. Now, if all of that fails, I think short run, we may need additional support to the European junior bonds just to get the system off the ground in the midst of a crisis. And so here's what we have in mind for that. So we envision that to further create liquidity for European junior bonds, the existing EFSF facility could take up the role as market maker in that market. And so in that role, it would always stand ready to buy and to sell these European junior bonds. And additionally, we propose that at least for a while in the transition period, the EFSF could provide a floor, a lower bound on the price of these European junior bonds, in the same way that a designated market maker provides a lower bound on a stock right after an initial public offering. Now, as is the case for all market makers, the EFSF would need to be well capitalized to play its role successfully and to credibly provide that price floor. And so we think it would have a credit line with the ECB, which would be collateralized by its inventory of European junior bonds. Okay, so in the unlikely situation that the EFSF would take a loss on its inventory of European junior bonds, the ECB would have a first layer of protection from the haircut that it would charge the EFSF on its credit line. And in an even more unlikely situation that the ECB would also take a loss, it could withstand some of the losses with its existing capital. But if that capital is not enough, then it would need to get automatically recapitalized. And so here our idea is the following. If a member state stands up to recapitalize the ECB, then it should basically get rewarded for that by a larger share of the capital in the ECB. Okay, and we think that if Germany stands up to recapitalize, France will also want to recapitalize, and the ECB will get recapitalized, and the political balance at the ECB will more or less stay what it is today. Okay, so we have in mind this unlikely intervention by the ECB and really a catastrophic scenario, and if that catastrophic scenario were to materialize, a recapitalization would be in proportion to basically the capital that is being brought in by each of the different members, each of the different Eurozone members. Okay, so now that you kind of know more of the design issues, more of the short-run questions, let me ask you a last polling question, which is the following. What do you think is the weakest link in the SB's European Junior Bond proposal that you've just heard? Answer A, it's not clear that there will be enough demand for the European Junior Bonds at prices that will make this scheme successful. Answer B, the solution relies on structured finance, pooling and tranching, which failed us miserably in the previous financial crisis. Answer C, the pricing of these European junior bonds is tricky. Answer D, banks cannot afford to swap their current sovereign bond holdings for SBs because they would have capital shortfalls. So let me turn it over to the moderator.
Okay, I'm going to send this question out to the audience, and we'll give you about 10 seconds to mark your answers. Okay, I'm going to go ahead and close the poll now and announce the results. And Stijn, on this question, we had 23% of the audience selected A, 26% selected B, 17% selected C, and 34% selected D.
Thank you very much. So let me conclude. So in our proposal, we basically proposed to create European safe bonds, which we think have the following advantages. They would smooth these flight to safety fluctuations that we currently see across borders between core and periphery, and they would replace them by capital valuation changes between European safe bonds and European junior bonds, which would stabilize the interest rates of sovereign nations. Second, they would break this diabolical loop between the banking and the sovereign debt crises, which is really plaguing Europe right now and making the situation pretty intractable. And third, they would provide a liquidity premium, these SBs would, and that liquidity premium, instead of just accruing to Germany, would now be shared between all European countries. That would provide some relief to countries that are currently in trouble. And of course, all of this would stabilize the financial market, bringing interest rates down for all countries, but especially for the problem countries. So we think this could be an important element to overcome the current crisis. That said, it's clearly not a panacea to all problems, because in parallel, we're going to need to promote medium-term growth prospects in all these countries through structural reforms, through financial stability, and through new governance systems that create prudent fiscal policies in the future. So the European top last Friday already made some progress towards that last goal of basically having more coordination between fiscal policies in the future. But I think one of the key challenges for Europe, at least in the medium to long run, is how to regain its competitiveness. And I think that's especially true for periphery countries like Portugal and Greece. Let me finally mention that this ESPYs proposal is just one element of a larger plan that we are developing with our group, of the Euronomics group. The two other aspects that we have spent time thinking about are, what to do with the European banking landscape, and what to do with and what about sovereign defaults? How can we make sovereign defaults more credible? Now, on the two-layered banking landscape, our current ideas are that we probably are going to have European-wide regulation of banks, at least of systemically risky banks. So we could have a two-tiered banking system where we have systemically risky banks that operate significantly across borders being regulated by a European-wide regulator, a regulator that would also have the power to, basically resolution authority in the case of a bankruptcy, and would be able to do an orderly unwinding. And then the second tier would be regional banks that are just very local and that could continue to be regulated by national bank supervisors. We also think the European banking system will need basically the equivalent of the United States FDIC, deposit insurance, because now countries like Belgium are very small, have large banks, and basically cannot credibly guarantee all the banking deposits of their national banks. So this whole system, like this European level deposit insurance, regulation, and resolution authority, we feel could also contribute substantially to the safety of the European economy going forward. Our last proposal is to think about sovereign default in more creative ways, trying to make it credible that a country could default without triggering the collapse of the entire Eurozone through contagion links. So all of this is a work in progress. Hopefully sometime next year we'll have a book come out with Princeton University Press, and in the meantime you can read about our updates on www.euronomics.com. Thank you very much for your attention. I'll now take some questions from the audience. Okay, so somebody asked what should be done, who will buy the junior piece? So I tried to provide an answer to that question. I think it's an important question. I argued hedge funds and sovereign wealth funds would be well qualified. I believe there would be substantial demand from the household sector, and then I tried to argue that in the short run maybe we will need the European Financial Stability Fund to basically be a market maker in this market, so as to encourage and stimulate the demand for these bonds. I think, in fact, people talk about leveraging the EFSF, and several proposals have been put forward to leverage the EFSF. I think our proposal can be thought of as a way to leverage the EFSF and basically use whatever 250 billion that is in the EFSF right now to create basically a demand of 5.5 trillion for European sovereign bonds. Somebody else asks, where does the 60% cap on the system come from? And also wants to know whether this threshold X is a dynamic threshold or not, or whether it's constant over time. So the 60% overall size on the cap on the system, I think, is important for two reasons. First, I think it's very important that we do not have this system or this EDA buy the entire debt of all European countries, because then we take away the incentives for them to undertake structural reform. It is crucial that sovereign bonds continue to exist in their current form, so that countries like Italy, or in the future also Greece, once it participates in the ESPY scheme, continue to see high interest rates continue to be punished by markets when they do not undertake the necessary structural reforms. So that's part of why we need a cap on the system. The 60% number strikes us as kind of an important number in the European design. It's that same 60% that also shows up in the Maastricht Treaty. On this threshold X, whether that would be changing over time, I think that is potentially a good suggestion. One could imagine that in bad times, in order to keep the system safe, we should have fewer ESPYs and more European junior bonds. And that's certainly one possibility, to have that be another kind of policy variable and have that fluctuate depending on the state of the economy. So somebody else wants to know, does ECB not print money? Why does it need to be recapitalized? So I think there's been a lot of discussion in Europe about the role of the ECB, and it seems like on the path that we are currently on, it looks like increasingly likely that the ECB will have to come up with a major bailout of the sovereign nations and maybe also of the banking sector. And so in that case, it would have to take on a lot of the credit risk that is currently still residing with the banking sector, as well as with the sovereigns. And it's not inconceivable that if that credit risk materializes, it would suffer losses and it would need to be recapitalized. I think an advantage of our proposal is that it makes the likelihood of an ECB intervention much smaller than what it currently is under current policy. So in our scheme, the role of the ECB is very minor. The ECB would only give a collateralized line of credit to the EFSF so that the EFSF could be the market maker for the European junior bonds. So these European junior bonds, if all goes well, would be trading in the market. The price floor may never be tested, so the EFSF may never actually have to acquire a lot of inventory, and so the ECB may never need its line of credit with the ECB. On top of that, the line of credit with the ECB would be collateralized, so that would give another layer of protection. So to make a long story short, I think the ECB in our proposal is there as an ultimate guarantor, but we envision that the probability that it would need to come in and step in is much, much smaller. It's a tiny fraction, it's a tiny probability, much smaller than it is right now under current policy. So let me look for another question to answer. Somebody wants to know, would this be a static portfolio or a dynamic portfolio of sovereign bonds? Would there be multiple issues or a single issue, multiple maturities? So we envision that this would be a static portfolio. It would be a dynamic portfolio in the sense that if the relative size of the economies in Europe changes, the portfolio weights would change as well. But because it would be the weighted average of the last 5 years of GDP weights, there would be a lot of persistence in the portfolio over time. Right, so let's say the Greek economy shrinks or the Italian economy shrinks a little bit over time. That would make the share of Italy in the scheme slightly smaller, but it would take a long time because of that 5-year weighted average. So it is a dynamic portfolio, but a slowly changing one. What about multiple issues? Well, we imagine that there would be, of course, multiple issues of these ESPYs and European junior bonds. The auction cycle, these could be auctioned off, just like U.S. Treasuries. And the auction cycle could be as frequent as every 2 weeks, like in the United States, or as infrequent as every 6 months. What about the maturities? That's a good question. We envision that there would be no maturity transformation. So I actually have a slide on this. There would be no maturity transformation that this European debt agency would undertake. So how can you ensure that? Well, we kind of have in mind that all the treasuries of the different European countries would be incentivized to issue the right type of maturity. Okay, so for example, if the Italian treasury knows that this European debt agency is looking to buy 5% of Italian GDP in terms of 2-year paper, then it will have a strong incentive to also issue 2-year paper. Okay, and so we could have a coordination in terms of what maturities are being issued by each country, so that the EDA itself would not have to do any maturity transformation. Okay, so we feel strongly that there should be no maturity transformation undertaken by the EDA because that would expose it to risk that we do not want it to undertake. Somebody else wants to know, based on our simulations, what would be the spread on the European junior bonds at today's market levels? So the answer to that is at today's interest rates, because interest rates on Spain and Italy and so forth are so high, the European junior bond would give a 10% yield to maturity right now. And the ESPYs would give a 2% yield to maturity, slightly similar to the Bund, slightly below the Bund maybe. But so the answer is 10% per year, which is in fact the number I used in the polling question. The same listener also wants to know, for the EDA to buy 60% of GDP, governments would have to provide funds. They would have to agree with a price. So I guess there is this question of at what price would the EDA buy the sovereign bonds. And so I argued that, I also have a slide on that. So I argued that we envisioned that the EDA would basically look at secondary markets for the price and then would offer that price and buy bonds in the secondary market. But in the run-up phase, we proposed that it would actually participate in the primary market so as to provide relief, funding relief to sovereigns that currently have a hard time placing their debt in the private market. So what price should it offer in that if it participates in the primary market? Well, we envision that it would basically participate in the primary market just like any other regular bidder. So it would submit a price schedule and a quantity schedule so as to basically try to have as little price impact as possible. Because one concern that you could have is that it would typically be buying the sovereign bonds at a very high price. It would buy it at the ask price, if you like, and it would sell the ESPYs and the European junior bonds at a low bid price. And so one concern could be, is this scheme gonna lose money? Is it even gonna be able to break even? Okay, and we think that there's certainly a lot of ways to prevent the scheme from making a loss. In fact, if all goes well, this scheme should be making a profit, and then that profit could be basically rebated back to the countries and would further alleviate the crisis situation. So another reader points out that ultimately this still relies on the credit quality and the backup of Germany. I think way down the line, to some extent it does, right? There's this kind of recapitalization of the ECB as a last line of defense. But the hope is that that last line of defense is a lot less likely than it would be under current policy. Right now, I think, in some sense, Germany is on the hook with a much higher likelihood than it would be under our proposal. So another reader wants to know, says that the non-euro peripheral countries, Sweden, Denmark, and so forth, have a decision to make about how to act in relationship to the euro crisis. Either they choose the UK route of stepping away from initiatives to save the euro, or they subject themselves to the suggested budget discipline and participate in the financing of the failed Club Med countries to an unknown extent. What would be your opinion on the most logical and optimal route for these countries to follow? I think that's a hard question. It's also a hard question because there's lots of legal issues as to what their options exactly are to stay within the common market and yet not participate in kind of the new round of integration that has been proposed on last weekend's summit. I think the UK government is either going to look prescient in a few years by basically dodging the bullet, or it's going to look isolated and it's going to suffer if Europe were to recover. So I think it's a hard question to answer. I think ultimately that depends on the preferences of the voters. I think it kind of raises this question of how much autonomy, fiscal sovereignty are countries willing to give up, in democratic countries. And I think the route of kind of moving towards more and more unity is clearly not the preferred option of a lot of voters in the European Union. And in some sense, one nice thing about our proposal is that it actually doesn't push us in this direction. It does not advocate more Europe. It does not involve a fiscal transfer union. In fact, it might actually be a way out that avoids more unification. And I think ultimately that to me seems to me like politically more feasible option, and as well as a more desirable option, at least from the perspective of some of the voters. Somebody else wants to know what, in my opinion, is the probability that in the next 3 years the required structural reforms do not take place in the Eurozone. On that front, I'm slightly more optimistic. In fact, I would argue that the only silver lining I see in the European crisis right now is that there's been a set of structural reforms enacted, or at least on the table and about to be passed by national parliaments, that would have been hard to conceive of as little as 6 months or 12 months ago. So I think we've made major progress towards reforming structural labor market issues in Spain, in Italy, in Greece. That said, a lot remains to be done in these countries, and it's ultimately still, the jury is very much out on how successful these reforms will be. In addition, I think a lot of these structural reforms come at a time of a recession. And often, structural reforms, for example, in the labor market, take the form of, layoffs, and so that further depresses the already weak economy. And so I think there's kind of this risk of, overdoing structural reform and austerity right now, because we're all kind of doing it at exactly the same time, and this coordinated this coordinated action may really cause a credit crunch. It may cause a recession, and so I think structural reforms should be undertaken, but to the extent possible, their kind of immediate implications should be somewhat mitigated, or at least their immediate implications for GDP growth should be mitigated. So somebody else is saying Greece debt is, let me take a couple more questions before we finish. So Greece's debt is trading at 50% haircut in the secondary market. How would EDA help if it offers to buy EJBs at the same level? So I guess the reader means, how would the EDA help if it offers to buy Greek bonds? So if it bought, just to be clear, in our proposal we envisioned that Greece actually would not be participating in this scheme until it exits its program that it has with the IMF, the ECB, and the European Union. Okay, but imagine that Greece has left that program and has undertaken some structural reform. Maybe it has taken that 50% haircut on its debt, and it's now on a path towards on a more sustainable path. So at that point, it would be admitted to the SB scheme. Imagine that Greek debt, for whatever reason, was still trading at 50% haircut at that point. Then essentially the EDA would buy it at those prices. Now the fact is that by having that sustained demand for Greek bonds, prices would recover in the secondary market. Okay, secondary market participants would understand that there's a large demand for Greek bonds, and that by itself would make the price of Greek bonds increase, so that ultimately the Greek sovereign would get a much better price for its bonds than implied by a 50% haircut. Final question I'll take is a question on what can investors do in the meantime to minimize their exposure to Eurozone European markets before this proposed infrastructure is available. Again, I think that's a pretty hard question. The obvious answer, of course, is to sell whatever European assets they have, bonds, bank bonds, bank stocks, and so forth. Now, of course, this will be taking place at somewhat depressed prices and fire sale prices right now. An alternative answer is to buy credit default swaps to somewhat hedge that exposure. Now, one problem with the credit default swaps is that there seems to be a set of contingencies where these swaps are not paying off. If you think about the Greek restructuring of a month ago, there's basically a Greek haircut of 50%, yet CDS contracts that protect against Greek default people decided that they would not pay off. So I think this was a bad decision, because I think a lot of European banks that were exposed to Greek bonds, rather than selling these Greek bonds to cut their exposure, they bought CDS, they bought protection on Greece, and in the wake of this decision, they now realize that the protection is pretty much worthless, or at least worth a lot less than they thought. And I think they basically decided to dump these Greek bonds instead, which caused interest rates to spike about a few weeks after this CDS decision was taken. So I think there's really not a lot of options other than just an outright sale of kind of sovereign and bank assets right now. Okay, so let me leave it at that. Thank you very much for your great questions and for your attention. Let me turn it over back to the moderator.
We want to thank you, Professor, for sharing your expertise today, and we thank, of course, the audience who joined us. A recording link for today's webinar will be sent out shortly, along with the PDF of the presentation, and we thank you once again for attending this Premia webinar.